Hi, I'm Audie. In today's video, we'll be walking through a post-market weekly review to understand the chart and gamma-based outlook for the week ahead. Right off the bat, the current market is defined by a constructive balancing act. Basically, stocks are still being supported, but there might be a limit to how high they can climb. We are seeing gold holding strong above its key breakout levels, and oil is bouncing purely because of headline-driven risks in the Middle East. At the same time, bonds remain weak because yields are staying high, which is preventing a completely clean, risk-on environment where everyone feels safe investing heavily. The big story right now is that fading inflation is colliding with rising concerns about consumer growth. On the good side, inflation measures like the CPI and PPI have cooled down, which reduced the pressure on the Fed to hike rates and helped stocks, gold, and tech. But on the bad side, retail sales and consumer sentiment fell sharply, making regular consumers feel worse and sparking fears of an economic slowdown. This leaves us with one core question: is the economy slowing down too much? When we track the key players driving the price action for the week, we see a lot of positive movement. The broader market, tracked by the SPY, was slightly up and held near its highs, while tech stocks in the QQQ remained strong. Semiconductors, or SOXX, continued their leadership, and small-cap stocks, represented by IWM, improved, even though they aren't leading the pack. Gold had a breakout that held steady, oil saw a strong return of its risk premium, and the only major asset that went down was Treasury bonds, or the TLT. The reason the market isn't just moving in one simple direction is that there are three conflicting forces pulling it at the same time. You have tech strength pulling one way, gold strength pulling another, and oil or inflation risk pulling a third way. This means the market, represented by the SPY, is balancing these three structural tensions simultaneously, preventing it from just rocketing up or crashing down in a single direction. To understand why the market is stable right now, we have to talk about gamma, which acts like a shock absorber for price swings. When the market has positive gamma, it moves in a controlled way where dips are bought and rallies are sold, keeping it confined to a tight, stable range. Negative gamma is the exact opposite, causing fast, emotional volatility where selling breeds more selling and leads to wild swings. Luckily, the SPY and QQQ are currently in a positive gamma structure, meaning we should expect a range-bound week unless a major event breaks those shock absorbers. Because of this positive gamma, major indices are currently trapped between fortified structural walls. For the SPY, there is a major resistance ceiling, or call wall, at $780, with an important support net underneath it between $769 and $765. Over on the tech side, the QQQ has a major ceiling at $740, a magnetic zone around $729, and a crucial zero-gamma support level at $716.86. Falling below these support nets is where the risk of heavy volatility increases. Looking at the specific engines of the market, semiconductors, tracked by the SOXX, are the unquestioned leader, outpacing everything else like a bullet train. Even though this sector is extended, it remains strong, so the best strategy is to buy during pullbacks rather than chasing the momentum while prices are high. On the opposite end, Treasury bonds, or TLT, are struggling and holding things back like a heavy anchor. The market is still worried about Treasury supply, fiscal risk, and oil-driven inflation, making bonds a weak investment despite the softer inflation data. When looking for the best investments, the cleanest macro setup is sitting right alongside a very dangerous wildcard. Gold, or GLD, is acting like a solid fortress, holding its crucial $398 to $400 breakout zone with a next target of $405 to $410. On the flip side, oil, or USO, is highly explosive and purely driven by Middle East headlines, so you should absolutely avoid strategies like naked short calls that bet against it right now. If the market is going to break out of this calm, current range, we have to track a few key data catalysts. With the CPI inflation data now in the rearview mirror, all eyes are on the health of the consumer. We will be watching retail earnings from stores like Home Depot, Target, and Walmart, along with the FOMC Fed minutes on Wednesday, and the S&P Global PMI data on Friday to see how people are spending their money. Depending on that upcoming data, there are a few dominant paths the market could take. The base case, which has a 40% chance of happening, is a range-bound melt up, where the SPY stays safely between $769 and $780, and tech holds its leadership position. However, there is a 25% chance of an oil shock or inflation scare scenario where oil rises sharply, 10-year yields jump, the Fed sounds strict, and tech stocks weaken as a result. There are also two outlier paths that depend entirely on consumer resilience and tech breakouts. There is a 20% chance of a consumer weakness or a growth scare, where retail earnings fall and small-cap stocks drop down. On the extremely positive side, there is a 15% chance of a bullish breakout, where retail is strong, the Fed is relaxed, and tech blasts completely through its resistance ceilings. Bringing it all together, our base case blueprint expects a heavily defended range, with gold taking the leadership position. The core assumptions here are that stocks probably won't collapse immediately, dips will get bought up by investors, and any upside movement is heavily capped near those major resistance walls. Gold remains the cleanest thing to buy, while oil is simply too dangerous to bet against using short premiums. Looking at the tactical strategy matrix for the week ahead, the biases for different funds are pretty clear. The SPY is neutral to slightly bullish, the QQQ and SOXX are bullish but their upside is capped or extended, and gold is strongly bullish. The best strategies involve using put credit spreads to buy dips on the SPY and QQQ, while waiting for pullbacks to safely enter into tech and gold trades. Ultimately, we are navigating the tension between strong tech leadership and rising macroeconomic risks. The final alignment shows that the cleanest trade right now is leaning towards gold, the best equity setup is buying pullbacks on tech, and the most dangerous move is betting against oil. The big question for this week is whether the SOXX and GLD can stay strong at the exact same time while oil and bond yields remain under control. Investing and options trading involve significant risk and are not suitable for all investors. The strategies and concepts discussed are provided for educational and informational purposes only and do not constitute financial, investment, or tax advice. Before implementing any investment approach, it is essential to consult with a qualified financial professional to ensure it aligns with your specific risk tolerance and financial goals. Past performance is not indicative of future results, and market conditions can change rapidly.